All right, so welcome to topic 5. So as I mentioned, we do have our midterm coming up next week. And today's session is effectively the first, or I should say the last week that we're covering in the midterm. So forecasting is effectively trying to estimate or trying to forecast the future financial statements of a firm. So in many ways, it's an exercise in predicting the future, which obviously nobody can do perfectly, but you can effectively try to do as good of a job as you can based on everything you would have learned in the past few weeks. So all the things you would have learned from accounting analysis. So for example, you might have found, if you, might have looked into things like goodwill, that you might find that goodwill is overstated, which means that in the forecast, you might actually write down the amount of goodwill. You might have found that they might understate some depreciation. And again, that would incorporate in the forecast because you would then consider that in the future. When we look at things like ratio analysis, where we try to understand why things went up and down, why revenues went up, why revenues went down, why profits went up, why profits went down. Again, that helps you in the forecast because you then start to understand what is a normal range for revenues. Because if I know that there was a huge jump upwards last year and it was only because of some weird event that only occurred last year, I'm not going to incorporate that huge jump in my projections into the future. And similarly, when we think about risk analysis, if you found that there is a significant risk of, again, we'll take the Buffalo Wild Wings prices of chicken wings as an example. If we find that there is a significant chance of Buffalo Wild Wings chicken wing prices increasing, so their input prices are increasing, that means that margins that we're projecting in the future, again, need to be smaller. So again, everything we would have done in the past few weeks kind of leads into forecasting, because forecasting is effectively the first part that you see in a valuation, because you see the forecasted figures and then you tend to discount them somehow to the present time. So the overall structure of the forecast is that we technically only focus on very few line items. So if I jump to the next slide, this is a condensed income statement. So if you've done the homework, you would have seen the structure of this little spreadsheet. And again, what you see here are very few line items, because again, if we look at the line items, there's probably about 10 different line items here. Whereas if you start to compare it against the line items we had in the data sheet, which is basically the raw data we got from Bloomberg, even for the income statement, we have about 20, 30, probably 40 line items just from the income statement. Whereas in the condensed version, we're really only looking at the key parts of this. And the idea here is that we're only taking a kind of a higher level view because we only need certain information in our valuation. And you might think, well, shouldn't we estimate all the different details? You might in real life if you have enough information. So say, for example, you're doing a forecast and you're working for the company itself, which means that you have access to management, you know the internal records, you know everything. In those in those circumstances, you might actually forecast a very detailed income statement. But when you have kind of limited knowledge and you have kind of the necessity to make certain assumptions, you want to make a few assumptions as possible, which is why we tend to forecast just a condensed version of the income statement. And I should probably note that this income statement, this example is for H&M. For your company, it might actually differ somewhat. So if your company, for example, which many of you have the situation, if your company does not report cost of goods sold, you can't use this particular structure. Instead of gross profit, you might instead try to forecast things like operating profit. So in many ways, some forecast items will look differently from company to company, but what we're focused on is trying to forecast as few line items as possible. So again, if you don't have cost of goods sold or cost of revenue, you don't have to forecast that line item. You would instead try to forecast some other line item. So instead of trying to forecast gross profit, you'd forecast operating profit, which is what you tend to have. In which case, instead of cost of goods sold, you would have operating expenses. So you basically just substitute for something that you might have. So the idea here is that here we have some kind of historical figures and we need to project it into the future. So what do we think will happen in the future? And that is kind of the focus of today. So when we're looking at, I guess, the overall structure of the forecast, what we tend to look at is just a few key strategic drivers. And you'll see that generally speaking, when we're thinking about drivers, it's really what drives the most important line items for your company. For about 80 to 90% of companies out there, the most important line item is sales. So whatever drives sales is the most important driver that you need to consider, because what you'll see is that sales dictates everything else in the forecast. So once you project sales, you tend to then look at other line items for relationships to sales to project them. Which means, technically speaking, the most important line item is sales, but it also means that if you get sales wrong, then basically all the errors then flow through to the other line items. So you basically need to make sure that you can justify your prediction of sales. But again, when we're looking at the income statement, the balance sheet, and the statement of cash flows, we're really only needing certain types of line items. And again, you could do it more detailed, but sometimes people mistake the idea that more detail means that you know more, whereas in reality, the more detail you have in a forecast, the more assumptions you make, the more kind of possibilities there are for you to have made a mistake. So when we're looking at forecasting, we're going to be looking at the past relationship of a firm's performance. So for example, if we go back to the previous slide, here are the historical kind of figures for the condensed income statement. So what we're going to be looking at when we're projecting this into the future is we're starting off with trying to predict sales itself. And we could look at the past sales growth, or we can use some other method. But for almost any other line item, we would then use its historical relationship to sales to try to figure out what that line item might be in the future. So you predict sales, and then you use the historical relationship between gross profit and sales to predict gross profit. So in order to understand kind of what our projection might look like, we are first going to be starting to look at performance behavior. And performance behavior is just the general way that companies tend to perform over time. The importance of this is because you want to understand how things change over time, in the sense that just because you've done really well in the past few years does not mean you're going to do as well in the future. And this is incredibly important for sales growth, because sales growth is a figure that has a mean reverting nature. So mean reversion or mean reverting nature effectively means that if you have high sales growth right now, over time, that sales growth is going to decrease in line with industry norms. On the flip side, if you have negative growth right now, it will increase over time, again, towards a more industry kind of standard. So this little graph just shows some data based on European firms from about 20 years, from the 90s to 2011. So what this graph does is that it looks at all the listed firms in Europe. Then it breaks them apart into 5 groups based on sales growth. So the top group is the one which has the highest sales growth. Then you have the next highest sales growth group. And then you have the bottom fifth, which is basically the ones with the lowest sales growth. If you then plot their sales growth over time, what you see is that after 10 years, even after about 5-ish years, the differences between these firms kind of disappear. The reason for this is really because of the competitive forces in industry. So if I see a company do really well, they're selling a particular product that they're selling really well, I'm just going to copy whatever they're doing. Which means that my sales growth should go up, and because I'm kind of introducing more competition to the good performing firm, their sales are going to go down. So no matter how you do it, it's very hard to sustain a high level of sales growth consistently. There will be some outliers, because we do have companies that tend to outperform the market, and these are outliers. So just because we know these really well-known companies, even a company like H&M, which I'm using as my example, they've had very high sales growth consistently over the past 20, 30 years. But if I were to project their sales growth into the future, over time, I would still consider the fact that their sales should go down. And again, when we're looking at this kind of performance behavior, Again, it holds for most companies, but for example, if your company may have a patent on something or a trademark that protects its position in the market, again, its sales growth won't revert to the mean as strongly. But even if you think about, I guess, companies which do have patents, like, I guess, pharmaceutical companies, over time, those patents expire. Once they expire, they've lost their competitive advantage. So again, it's very hard to maintain an above industry average sales growth over time. And again, this is basically just sales growth, which means that if we know nothing about a business, say for example, we just have its historical financial performance, so we only have this to work off. If we only have this to work off, in order to project sales into the future, we could look at the average sales growth over time. But then if we are going to be projecting it into the future, we need to start incorporating mean reversion. So for example, here, I think H&M has grown at about 10%-ish per year, or a bit more in some years. Again, for 2017-18, I might look at what the average for the past 3 or 5 years has been, if I know nothing else. But then from 2018, 19, 20, 21, I'm gonna start to decrease the sales growth. And again, this is if I know nothing about a firm, because I know that in general, the general rule is that the company's sales growth will revert back to its mean. So again, this is just like one of those tricks that you can do in order to kind of speed up a forecast. Similarly, if we're looking at the profit measure, so back in the ratio analysis week when we talked about profit, we looked at return on equity as kind of the dominant ratio for assessing a company's overall profitability. So we can do a similar exercise for profitability and return on equity. In a sense, we're looking at a company's return on equity in year one. Look at the ones, with the highest return on equity and the ones with the lowest, and essentially try to divide them into 5 groups based on the level of return on equity. Again, what we see is a reversion to the mean. Now, this reversion is not as strong as for sales. Now, when we're looking at the reversion to the mean and return on equity, you still see that very profitable firms tend to become less profitable over time, and those which basically are losing money right now tend to become somewhat profitable, or at least if we're looking at one which had almost negative 40% sales growth, return on equity, they go to about making 0 profit. So at least it's getting better. So again, it's not as strong of a mean reversion as sales growth, but there's still some reversion happening here. Now again, if you remember from ratio analysis, when we're thinking about return on equity, we don't just look at return on equity, we can try to decompose it into its components. So we know that return on equity is based on net profit margins, its asset turnover, and leverage. So we can try to look at what is actually driving this mean reversion of these 3 different components. So if you were to plot the different components, what you would see is that technically asset turnover and leverage tend to be stable over time, which means that it's the net profit margin that is more or less responsible for the mean reversion when it comes to return on equity. And again, it kind of makes sense because net profit margin is based on kind of your profit in relation to your revenue. So it's all about those expenses. And again, increased competition means that your expenses will go up in relation to your revenue. So again, if you, for example, have an increased competitor coming in, you might have to spend more on marketing. If you have a competitor coming in and taking your employees, you might have to spend more on employee expenses. So all these competitive forces effectively drive net profit margins down over time. But again, I want you to also remember that it works both ways, in the sense that if your company is doing poorly, you can assume it's going to improve over time. And it kind of depends on the industry mean. So in a sense that this exercise is done across industries. Whereas if you look at your company, it's really influenced by the competitive forces within its industry. So just because your company has a 20% return on equity right now, and it looks great to the rest of the market, what you should look at it in relation is to your industry. So if the rest of the industry might have 30% return on equity, you might actually incorporate an increase in return on equity over time for your company. But again, these are kind of like shortcuts that you can try to think about, I guess, to try to project into a longer time period. In the short term, what we're looking at is really everything that we know about a company. So again, as I mentioned, when we're looking at forecasting, we're really taking everything that would have learned in the accounting analysis and the ratio or financial analysis and the risk analysis, and then incorporating them into a forecast scenario. So if you're looking at, I guess, what has driven past financial performance, we could look at it as from economy, industry, strategy. So essentially, as when we talked about the ratio analysis, we have some market forces, so the economy as a whole, macro, we have industry, and then we have company-specific like strategy. These three things are driving past financial performance. So we can understand what has driven financial performance and essentially be able to explain why has net profit margin gone up or down, why has sales gone up or down. We can understand what triggers those increases or decreases. Because once we know what triggers them, we can then try to start to think about what will happen in the future. So for example, for H&M, if you were to do this exercise, you would figure out that past financial performance, specifically if we start with sales, is primarily driven by new store openings. So for any retail company or any company that has stores or even like restaurants or whatever, they have like a location, generally speaking, they drive sales by opening new locations. Yes, you can try to improve the sales in a specific location, but generally speaking, most of your sales growth will come from new store openings, which means that if I'm trying to predict future changes, I'm looking at future changes in stores. So again, it might be slightly hard to figure out how many stores will a company open, but technically speaking, most companies are very transparent about their future plans. So even when we do any kind of forecasting, we tend to have quite a lot of information given to us by management. So every year, I should say probably every quarter, management will give you their earnings guidances in the sense that if it's a publicly listed firm, a company will be very transparent about what they predict the future to hold for their own business. So they'll give you the profit for next year, what they believe it to be, they'll give you the sales, they'll give you the expenses and everything. Again, this is the view of the management, which means that you can't necessarily just take it at face value, but it's still a source of information. Part of that information might include information about these important changes. So for H&M, they actually release information about how many new stores they're planning to open in each particular location in the next few years. Again, it's not always as easy, but it's still a kind of a source of information. Because once you know some of these future changes, you can then try to predict the future financial performance. And again, if we think about even what we covered last week with respect to risk analysis, if we know that something is very risky with respect to its performance, so we know that something has a very high probability of occurring and will have a high impact, this is where we are going to be incorporating that. So again, if we know that chicken wing prices are projected to increase in the next few years, we incorporate that here. So our risk analysis feeds into here, into predicting the future, which drives our future financial performance. But again, everything that we do in this class is guessing. We're just guessing. Nobody knows the future. So even when you see in a financial statement, when they estimate the value of assets and the line items, if they're valued based on some form of valuation model, they are guesses. So you can never know the future for certain, but you can do an educated guess. So the idea in this class is really we're trying to learn how we make educated guesses that essentially allow us to value a company. So if we're looking at, for example, H&M, we could try to look at its past performance. And again, we kind of look at its past performance to try to understand how the economy, industry, and the strategy would have driven it. Once we know that, we can try to figure out, will these three things change in any form of way? So if we're looking at macroeconomics, how will the economic situation develop as a whole? And again, this sounds really easy, but this is actually quite difficult because generally speaking, when we're looking at companies these days, they tend to operate in multiple different countries. So for example, H&M, which is probably in about 30 or 40 different countries around the world, if not more, you would then have to figure out what is the macroeconomic kind of predicted change for this portfolio that they particularly hold. So you can't just look at GDP change in Sweden because it's a Swedish company. You need to somehow weigh their geographic segments if you want to do it properly. And similarly, if we're looking at industry analysis and it's kind of strategy analysis, we want to look at things that might impact their margins, that might impact their sales, and so forth. So when we're looking at industry analysis, we might look at the competitive forces. So do we expect there will be higher or lower competition? Will we have a strong or a weak position when we bargain with our suppliers? So again, these are kind of things that would be part of an analysis from, I guess, a Porter's 5 forces perspective or something like that. And the idea here is that we're thinking of all the particular things that drive H&M's past performance and if they might change in the future. So again, things like advertising campaigns, competition within the industry itself. Will new discount retailers threaten us? Will we have lower bargaining power with our suppliers, which means that our expenses will go up? So all those things feed into our prediction for the future. And again, if we're looking at H&M specifically, H&M has this particular situation where it has more or less grown to maturity in certain countries, which means that in certain countries, it's actually really difficult for it to open up new stores just to increase sales. So it's not, the formula is not as easy as open up a new store and increase sales. Because for example, if I look at Sweden, if they open up a new store in Sweden where they probably have a couple thousand stores already, they're not necessarily going to get new customers that give them new sales. They're only going to get existing customers that just shift their preferences from other stores to the new store. So they're essentially kind of cannibalizing their existing stores. So again, all those things kind of make a difference. So again, if H&M needs to grow, it's going to grow in new emerging markets. On the flip side, those new emerging markets might not have as high of a sales figure per store. So you can't just look at its average sales per store and assume it's going to hold in an emerging market. So again, when we're looking at all these things, we're going to be considering everything that we learned. So again, from accounting analysis, we might look at past behavior. Have they misstated things in the past? Have they done things to kind of make us suspicious in the past that would kind of implicate that we need to consider this for the future? So again, when we're looking at the forecasting process, this is very high level in the sense it's kind of abstract. So things like assess the relationship between step 1 factors and financial performance. So in a sense, how does macro, industry, and strategy impact financial performance? To a large extent, it's a very qualitative type of analysis. You need to understand how does everything relate to one another. So again, what we want to understand is how things in the past caused, how things, within the macro, industry, and strategy affect performance in the past. So that if we know that the relationship and we know what we predict for the future for these things, so the future changes, then we know kind of how it might affect future financial performance. And again, this is not easy. It is guessing. So when you do this for your company, you're not gonna, I don't expect you to know the future perfectly. You're guessing, but you're doing so in an educated way that you're trying to draw upon evidence to do so. So again, step 3, basically forecast condensed financial statements. So when we're looking at this exercise, there's many different ways you can do it. So as I mentioned, the most important figure that we're looking at is really sales growth. So if we can get sales growth right, everything else is very easy because everything else more or less relates to sales growth. So the way that you kind of determine sales growth will be industry dependent. So if you're an industry such as a retailer like H&M, you're going to be looking at how many stores they have because that's kind of what is driving it. If you have a different kind of industry, it's not going to be as easy. But there are certain shortcuts that you can take and I'll show you how to do them. So again, when we're looking at sales growth, one of the first things that we might do is just look at the macroeconomic exposure because again, we're looking at macro industry strategy. So some companies will not be driven by macroeconomic factors. Some of them might actually be boosted in recessions. But you want to kind of understand what is the general industry kind of exposure to macroeconomics. In H&M's case, it is a clothing retailer, so technically speaking, the apparel industry is cyclical in the sense that it does do well when the economy goes up, and it does do poorly when the economy goes down. In H&M's kind of for their own benefit, generally their exposure related to the rest of the industry is probably not as strong because they sell cheap clothes. So if you were to sell more expensive clothes, you would have a much higher exposure if the economy tanked. Because again, people do need clothes, but they don't need Gucci, they don't need Armani, but they do need clothes. So similarly, when you're thinking about any kind of product that your company sells, is it a necessity or is it something that is more discretionary? So do people need it or do the people want it? So there are two different things. So again, you might look at economic growth rates in the past and into the future, because again, future growth rates, specifically when it comes to things like GDP and so on, these are things that you would get quite easily from Bloomberg or from even just Googling these sort of things, because there's so many predictions of these out there. And again, what you might do is you might look at the portfolio of your company in the sense that if you're operating in multiple different countries, you try to weigh each country in accordance to some form of metric. Usually it might be related to probably either the profits you get from that country or the sales that you get from that country. So it kind of depends on what you prefer. But again, you try to understand what is the economy going to do in the future. Because again, if I know that there's a dip in the economy in general that I'm expecting into the future, I'm going to incorporate this into my forecast, because I know that H&M, even though it's not hugely impacted by macroeconomics, it will still be somewhat of a downturn. So I might incorporate that into my forecast. If I see that the projection is increase in GDP growth over time, again, incorporate it into your forecast. So it's all these kind of little pieces of evidence that you take in to try to predict the future. So again, as I mentioned, when we're looking at H&M or any kind of retailer or any stores that, or any company that operates stores or locations, their sales tend to be driven by new store openings. So depending on what company you're analyzing, this driver will be very, very different. For some companies, it's not going to be an easily observable driver such as this, because this is actually quite unusual, because retail stores in particular are probably the easiest industry to try to project. So what we would tend to look at is what have they done in the past and what are they going to do in the future. So here we have numbers from 2010 to 2014. We have 2 actual years, and then we have the estimates for the final 3 years. So we're looking at the growth rate in the past, and we're going to be looking at the growth rate in the future, because what we're going to be looking at is how many stores do they have each year that they're adding to their portfolio, which means that how many stores do they have in total throughout the year. What this will tell you is that it will tell you the average number of stores. So essentially you look at how many stores did they start off with, how many stores did they end with, take the average of that, and that gives you an average number of stores they had throughout the year. What you then need to figure out is effectively the sales per store. Now, this little table is a bit complex, but all it's trying to figure out is kind of what the expected sales per store are. So generally speaking, the previous little slide would have established how many basically the average number of stores that we have per year, both in the past and into the future. What we're doing here is we're trying to multiply that by a number of sales per store. So the expected sales per store, and we're going to be multiplying them by the expected average number of stores. The expected sales per store, you could just make it very simple. You could just look at the past sales per store. So we could look at just the line item here where it's, I guess, line item B, where it says sales per store in 2010. So it was about 51 million kroners, about almost 52. You could just look at that if you know nothing else. But because you would have learned some things in your ratio analysis, in your accounting analysis, in your risk analysis, you can start to incorporate some of these things. So for example, you might look at the existing sales per store as a base, and you might adjust it based on what you think will happen to important drivers of the sales per store figure. So you might look at currency exchanges. So if we believe that H&M is very exposed to currency fluctuations, which it is because again, it's a company that's headquartered in Sweden, but it probably generates most of its sales abroad, which means that currency is very important. And even though you could get financial instruments and you could try to protect yourself, it's still going to cost you money and you can't completely eliminate that risk. So generally speaking, for any company that has a lot of money coming in from abroad, you tend to almost always expect somewhat of a conservative figure in the sense that you almost always expect that they will lose money on currency exchange rate changes. You will also tend to have some changes in the store portfolio. So in H&M's case, we know that its existing stores are primarily in Western Europe. Its biggest growth market is Asia right now. I know that the Asian market, the sales per store there is not going to be as high as in Europe. So you might say because of the changes in the store portfolio in the sense of where they're located, there's going to be a decrease. Again, these numbers, even though they seem precise, 5.48, 0.24, these are guesses. So it's somebody who's made an educated guess based on what they've observed in the past. And these numbers are to some extent also gathered from the financial statements. Because H&M, when they provide their annual report and they talk about the past performance for the year, they would have also talked about the fact that the sales per store might have dropped in 2010 or 2011 by 5.48% because of exchange rate fluctuation. So it's not that you have to guess that, you will generally have some pieces of information, which means that you can use that information. So it's not like somebody made a hugely advanced financial model to figure out what the currency rate changes will do to H&M. It's because they know they've reported that this was the impact in this particular year. So I'm going to assume that this impact will kind of stay on into the future. There will also be things like, in H&M's case, changes in consumer demand or inventory markdowns, in the sense that they're losing money. Because they have to mark down inventory because consumers have slightly less demand. Again, you will try to use information from the company. So again, this number of 3.59, you would have gotten from the annual report. So the annual report will be quite transparent of why sales per store are not as high as they should have been in 2011. So if we know why they, I guess, are decreasing in 2011, we can try to figure out what might happen in the future. So generally speaking, changes in consumer demand is completely directly linked to what we talked on the, let's see, this slide. So the macroeconomic kind of trends. So generally the consumer demand will be very closely linked to macroeconomic trends. So if we know that in 2011 it kind of goes down again, so we don't expect as high of a growth rate. In 2012, we don't expect as high as a growth rate. In 2013, we expect it's going to go up again. We can try to incorporate those kind of trends over time in the sense that we do assume that this is going to stay on in 2012, but then over time this will disappear because the economy gets better. Again, 1.8, how did this person get 1.8? It's a guess. It's an educated guess in the sense that they know that the economy is going to do better based on predictions. So we expect the consumer demand decrease is not going to be as high over time. So again, what we have here is effectively just adjustments to the 2010 sales per store to figure out what is the expected sales per store for each particular year, multiply by the average number of stores for that particular year. And you have expected sales, which means that you can also calculate the implied sales growth. So again, this company is probably, even though it looks a bit complicated, this is probably the easiest example out there when it comes to predicting sales growth. For most of your firms, it will actually be much more difficult because you don't have as a transparent driver as stores. So for some of you, it might be a bit trickier to figure out what do I actually expect. So in these instances, what you tend to do is you try to look at other pieces of information. So for example, if you don't know something and if you don't understand something in class, so say for example, Emily doesn't understand something, she'll be asking like, Judy, what did Tim say? I don't understand. And this is exactly what you can technically do when you're predicting these things. So generally speaking, when I look at prediction of any of these numbers, I might use Bloomberg just to get a bit more information. So for any of your firms that you're kind of trying to value right now, there would usually be a few other professional people doing exactly the same thing. So there will be analysts out there who are more or less tasked with following your firm and providing estimates for that particular firm. So when I do any form of evaluation for a publicly listed firm, I would incorporate those predictions. So in Bloomberg, if you type in EEB, estimate consensus detail, and I'll cover it again soon, it just gives you, whoops, disappeared. Let's see, EEB, we have Time Warner, estimate consensus detail. We have an overview of people's predictions for certain different line items. Looks like I have an error. Let's see if I need to restart or not. So here we have an overview. It looks a bit complicated, but what this essentially does is it gives you a number of different analysts. And again, analysts works for investment banks, brokerage firms, and their jobs are to predict things about your company in order to provide shareholders with buy, sell, or hold recommendations. So in some of these cases, we don't know exactly who this analyst is, but in other ones we do. We know that Pivotal Research Group, and specifically Brian Weiser, has made a prediction when it comes to earnings per share adjusted for the 2018 quarter one of 1.74. Again, you don't really need quarterly information, so instead we might look at things like revenue. We might change the measure to revenue, and we might say instead of looking at the quarter, I want to look at the yearly number. Which means that I get an overview of what everybody is guessing for 2018, for in this case, it's Time Warner Inc. So again, you get an overview, and specifically here you have the estimate consensus. In a sense, you know what the mean estimate is about 32.5 billion. For 2019, we know it's about 33.9 billion. We know what the low and high is, we know what the median is. So it kind of gives you an idea, yes?
How do you know if the analyst's forecast is accurate?
You don't know that, so generally speaking, this is kind of like a sanity check. So in many ways, if you don't know anything about a firm and you're just kind of guessing, which to a large extent we're doing in this class, you use this as a sanity check. Because if you're projecting through like 40 billion for 2018 and it's high amongst all the analysts is about 33, probably you made a mistake somewhere. So kind of like a sanity check. And again, sometimes we do have access to the actual report. So for example, when you have a document here, not always, but sometimes when you do have that document and you click there, you get a report. In this case, I didn't, so I basically just go back and try to find some other one. So generally speaking, Bond has access to some, but not all. So in this case, we also have something here that's called the BRC function, which just shows all the analyst reports that you have access to. So any kind of document one here, you can usually click on it and you hopefully see it. Sometimes it doesn't work, sometimes it does. So here, for example, it looks like it's gonna work. You get the PDF, so basically their recommendation and how they arrived at it. So even though it seems, and you'll see soon, this is a 6-page report from Pivotal Research Group on Time Warner. It's basically an overview of, like, for example, what if they've done in the past past quarter, their valuation, their risks, like pay TV slowdown, threats to TV advertising, and so on. Then their discounted cash flow model, and so forth. Again, I would say, even though this seems like a great piece of information, a lot of times it's actually quite technical, because you have to remember that these people work on a quarterly basis, and they're focused more on changes. So you won't necessarily know exactly why they believe the sales for that quarter is going to be, let's say, 10 billion, but you will know why they believe their projection of that quarter's sales have grown from 9.5 to 10 billion. So they're focused more on changes in their assumptions. Because again, this person would probably issue almost like monthly reports for Time Warner. So they kind of assume that you as a reader would have followed all of their previous reports. So they're not going to go through everything entirely. But again, it's still a source of information because you get some kind of evidence that you can try to refer to. Again, not every company will have this, but if you have a large company, you will generally have quite a lot of analysts. So in this case, we have how many estimates? about 13, if I scroll down, about 30 different estimates. And again, you can see an overview of the estimates here where it says we're using 27 of 30 estimates. So essentially 27 analysts provided estimates for revenues in 2018. And again, you're not going to use this as the true figure. It just provides with some source of information here. And you might think, how did the analyst actually arrive at this? Again, the analyst is not some genius that knows everything about the company, is accurately able to predict sales. To a large extent, these analysts are reliant on managers. So every quarter, managers will have a quarterly earnings call where they talk about how they've done in the past quarter and what they think will happen in the next one. They're going to give you some projections, and analysts can ask questions during those calls, and those are all public records, and you can actually see them on Bloomberg. But the idea here is that they've actually used information from managers, and then they might have adjusted them based on the fact that, for example, they might know that manager A, or this CEO in particular, tends to understate their prediction for the future. Because if they understate the prediction for the future and then they deliver something above their estimate, it looks like they're doing really well. So you're trying to look at historical trends in management guidance to try to understand how you might need to adjust them. So again, there will be differences here based on each analyst's adjustment, but generally speaking, all of them use management guidances as the starting point for their own analysis. So again, when we're looking at this kind of whole process, even though you don't have sales per store, you will have some information that helps you in the process. So similarly, if we think about margins, so as I mentioned, when we're looking at sales growth and I guess margins, those are probably the two most important items because they tend to revert back to the mean over time, which means that they're very much exposed to changes over time. Other ratios tend to be somewhat more stable. So similarly, when you're looking at margins, you could do a similar exercise as you're looking at the margin in 2010. In this case, it's the net operating profit after tax margin. And you can look at things that might impact it. So you might look at input prices. So are input prices increasing or decreasing? If we think our input prices are increasing, so in 2011, we might have looked at the annual report and they might have said to the readers that the profit margin was 18.1 in 2011. It's less than we expected because input prices increased, which caused our margin to decrease by 1.35%. So these numbers are usually taken from management because we know how they're essentially justifying that their margin was less than they thought it would be. And we then use that information to try to predict the future. So in H&M's case, you might look at input prices. So in H&M's case, you might look at things like cotton prices, wool prices, all these materials that they're using. So even though H&M, technically speaking, does not manufacture anything themselves, they're buying it from outsourced suppliers. Those suppliers' prices will be based on input prices, which means that H&M's margin is still based on input prices. So again, I might see that over time, the prices of materials are actually going to decrease. If it's going to decrease over time, it means that their margins are going to improve. When we're looking at things like inventory markdowns, again, inventory markdowns might have happened because we had a change in consumer demand. Yes?
Margins revert as well.
Yes, so margins tend to revert back to the mean in the sense that over time, on average, I should say, we would expect that a very high industry margin would revert back to the mean. Doesn't always need to be the case, but if I know nothing else about a company, I'm just going to assume that. If I know some things about a company, I might still have it in the back of my mind, but I would still use my information about the company as probably my first starting point. So again, we're just looking at anything that they said impacted them in 2011 and try to figure out how that might change in the future. For example, inventory markdowns. Well, I know that inventory markdowns are to some extent related to the fact that they can't sell stuff, which is somewhat related to consumer demand. If I know that the economy is getting better in 2013-14, that is no longer going to be a problem. We also have things like SG&A, so sales, general, and administrative expenses. It says SG&A cost stickiness. SG&A cost stickiness just means that certain costs or expenses that you have are sticky. So sticky costs means that those costs are to a large extent fixed. So if you remember from your management accounting days, some costs are variable, some are fixed, which means that if you have a decrease in sales, you generally have a decrease in those costs if they're variable. If they're fixed, they stay the same. So stickiness generally refers to the same kind of concept. So when we're looking at SG&A expenses, sales, general, and admin, we're looking at a lot of employees, and employees are generally speaking hard to fire in certain circumstances. So just because your revenue took a hit in this particular quarter or this particular year does not mean that your SG&A expenses will decrease by the same amount, because you can't fire people randomly and then hire them the next day just because sales went up. It doesn't work that way. So in many cases they're sticky. So again, what we're looking for is really anything that could have impacted the margin in the past and projecting it into the future. Again, seems simple, but it's actually a really hard exercise. Generally speaking, you could try to figure out these numbers from the annual report, from the earnings calls, even from analyst reports, and then you try to project it into the future. And again, when you project into the future, you could still use the analyst reports if you have access to them to try to see if they make a prediction of these numbers. Sometimes they don't, in which case you essentially need to more or less make a guess yourself. Question, do you guys want to break? Yes, cool. Come back in 10 minutes and we'll continue then. All right, so we can kind of slowly continue. So what we've done so far is really talked about kind of some of the basic assumptions that we have when we do a forecast. Some reason it's not working. No, it's not responding. Let's say close. Okay, cool. So we've talked about the margins in the sense that we can try to figure out what the expected margin should be. But generally speaking, if you've done the homework, you would have seen that there's a whole range of other assumptions. In the sense that the homework kind of, if I go back to the Excel spreadsheet, kind of looks similar to this. So we have our inputs like always, we have our historical patterns, and we have our forecast patterns. And again, these patterns are all based on the condensed income statement, condensed financial, balance sheet, condensed cash flow statement, and so on. So we know what our kind of historical figures are. And again, if we can figure out what sales growth should be, then everything else kind of falls into place. So I'm going to go through almost every little assumption that we're making here and explain kind of what the thought process should be when we're kind of looking at those assumptions. So again, when we're looking at any kind of forecast, it's all based on previous patterns. So this would be the patterns that we've had in the past based on past financial performance. So we know what the previous sales growth, profit margins, depreciation to total assets, interest rates, and so on have been. And what we're trying to do is figure out what should they be in the future. And again, like always, these are guesses, but they're somewhat educated guesses. So again, when we're thinking about sales growth, as I mentioned, when we're looking at a company with stores, like H&M, we would use number of stores. In other examples in other companies where it's not that easy, again, as I mentioned, I would use management guidance. I would use the other analysts and see what they think. I might even look at the average sales growth for the past few years. Generally speaking, just looking at the average sales growth, it's really bad way to do it, because generally speaking, companies change over time, and just looking at the average is only really appropriate for a ratio that's quite stable. Because really, if a company's sales growth is jumping up and down, well, then perhaps looking at the average is not that useful. So for example, if I look at sales growth here over time for H&M, it's gone from 9%, 6, 17, 19, 6. So it's jumping up and down quite dramatically. So looking at the average, well, we might say it's about 12, 13. Again, it's a bad way to do it, but you might just do it if you know nothing about a company. You might either take the average or you always take the last year. So those are kind of the two approaches if you know nothing. And again, if you know nothing, you would almost always consider a mean reversion. So if you think that 2017 should be 13%, then over time, if I know that the industry average is about 6, 7%, I just incorporate that mean reversion into my projection. And again, these are just guesses. and I'm justifying them with the fact that there are mean reverting tendencies in sales growth. Really, the biggest concern that you have for yourselves is really getting the first kind of 2 years right, or somewhat right. And again, you would use those analysts' forecasts as a sanity check. So even though I see that the average sales growth in the past might have been about 12%, for 2017, I might say 12 or 13%, but I would still use the analyst forecast as a sanity check because they might say it's going to be 0. Because, and again, I will then go into their research reports and they tend to explain why they believe it's going to be 0. And then I say, okay, now I see, and I can try to adjust my own predictions if I believe them. Yes?
How would you test us on a concept like this if we're kind of like projecting?
Test it how?
Yeah, for the mid-semester exam, how would you kind of go about giving?
It's more about justification of your assumptions. It's more about the justification of the assumptions and all. So basically knowing some of the ways that you could forecast items and some of the theoretical concept like mean reversion that you'd basically use to assist yourself. So again, it is basically being able to justify what your decision is. So a lot of this class, again, there's no right or wrong in most cases. There's really just a good justification and a bad justification. But you could arrive at very different predictions based on what you think or believe. Now, projecting margins, and again, projecting margins generally is based on some form of historical relationships. So we know that margins, they do to some extent revert back to the mean. So if we know nothing else about a company, we might incorporate that in all our margin predictions. And again, as I mentioned, gross profit margin, it's only relevant if your company reports cost of revenue or cost of goods sold. If your company does not report that, you might skip ahead to operating profit margin. You might use some other margin essentially. But all those margins would have a mean reverting tendency. Generally speaking, they tend to be somewhat more stable than sales growth over time. If I go back to H&M, so for example, gross profit margin, it's kind of decreasing over time, so it kind of seems like they have some kind of mean reversion happening already. We also see that it's basically not as volatile as the sales growth. So sales growth go up, down, up, down, up, down. The margin is somewhat stable. So again, you might say that, okay, if I know nothing about a company for the margins, I'll probably just use the last financial year. So almost for all of these ratios, if I know nothing about a company and it's somewhat stable-ish in the past, I'd probably just use the last financial year. If I know stuff, I would adjust it. So again, it's basically just trying to figure out some kind of a rule of thumbs that you can use to kind of assist yourself. So again,
is it best to get a base number, like for example last financial year, and then make your adjustments based off that number?
Yes, okay, so in terms of mean reversion, or what do you mean? Or
Yeah, mean reversion, or the other thing, but
yeah, so
sort of starts and then.
Yeah, so for example, if I say that it's going to be 55.66% here, it would have been based on a similar kind of logic like this one, in the sense that I know that in 2010, their margin was 18.1%. I know that in their annual report, they said that these particular factors impacted the fact that their margin in 2011 was lower. So those things would then also come into play for predicting in the future. So you try to understand why has it been impacted in the past, and usually you probably use the last financial year because that's the most relevant when it comes to the margin, and you then try to project it into the future. So again, when it comes to all these margins, you tend to incorporate a mean reversion, but again, remember, just because I'm kind of going downwards with H&M does not mean you have to go downwards with your company. If your company's not doing so well, your reversion could be upward. So your margins could be improving over time. But again, generally speaking, we might use the last year just to get a quick understanding. When we're looking at some of the other items in the, I guess, condensed financial statements, we will have depreciation expenses. So depreciation expenses you can use many different types of approaches. So some people use things like depreciations to sales. You could also use, to a large extent, some kind of an asset figure. So in this example, I just used total assets, which is a very crude way to do it. because technically you could look at it in relation to your property, plant, and equipment, which is really the account that gets depreciated. But in my case, because I didn't really want to project property, plant, and equipment, and I just wanted to project total asset because it means less line items, I'm just going to look at it in relation to total assets. So I might look in the past. So again, I might look in the past. What has the depreciation to total assets been? It's kind of increasing over time. So here I would say really there's no right answer. It's guessing and trying to justify it. Use the last financial year for simplicity, or if you believe that there is an underlying reason for why their depreciation rate is increasing over time, you could try to incorporate that. So if it is increasing over time because they are, again, buying new equipment or renewing their asset base, you might change the current depreciation rate. It's not going to be drastic, but you're going to be incorporating that. And again, just because depreciation rates have, as you've seen, gone up from 5% to 7%, and you're going to try to incorporate that trend, don't do that, because over time it's going to be up to like 20%. So you're trying to understand why has it gone up, and again, that goes back to your ratio analysis and explaining why. If you can explain why, you can usually figure out what the reasonable number is for next year. And again, generally speaking, it should be somewhat stable. Now again, if you're working in the company and you know everything about the firm, you know their plans for opening new plant facilities, buying new machines, you have access to depreciation schedules, you can go crazy and do it very, very detailed because you have really great information. If you know nothing, you basically just use a very crude estimate based on some asset figure, or you might even look at it in relation to sales. Now, if we're going to be looking at it in relation to our total assets, we obviously then need to project our assets. Now, our assets are directly linked to the sales that we have. So if you remember, our asset turnover is really about how efficient we are at using our asset to generate sales, which means that in order to generate a certain number of sales for next year, we need to have enough of an asset base to generate it. So if you're predicting a sales growth of 50% for next year, that sales growth is not going to come from this particular asset base that you had last year. That asset base will also grow. The way that you account for it is that you look at the asset turnover. So the asset turnover ratio would then help you to figure out how much assets do you need in that year to generate a certain level of sales. And again, when we go back to the, the slide a few kind of in the beginning of the lecture, when we looked at the mean reverting tendencies of return on equity, we know that asset turnover tends to be quite stable. So generally speaking, I'll probably use the last year, assume it's going to be stable. Again, if I know more information that I know that management is going to do something about trying to improve efficiency, I might incorporate that. But there's nothing wrong with just assuming stability because I know it's quite a stable ratio. So if I know it was 1.95 in 2016, and it was that number because that is somewhat normal, I might just assume it for the rest of the period. And again, once I know the asset turnover ratio for that period, I know that I need 1.95 I generate $1.95 in sales for each asset dollar that I hold, which means that if I already projected sales, then I can figure out what do I need in assets to generate that. And similarly, when we're looking at liabilities, well, liabilities will be based on your leverage. Leverage tends to be somewhat stable, which means, again, if I know that total liabilities to total assets have been 37.88% in the past year, and it's been somewhat stable, I'm going to assume that. If I have more information about a company saying that we're going to try to decrease our leverage over time, I'll incorporate that. So again, if you know nothing, almost always assume the past year, unless it's like a super weird year. But if you have more information, you start to incorporate things. Similarly, when we're looking at things like financial debt to total assets, so financial debt is really your interest-bearing debt or your interest-bearing assets. In this case, it's negative because H&M actually doesn't have interest-bearing debt. It has interest-bearing assets. So in many ways, again, it might fluctuate, but it's not going to fluctuate very much, which means I'm almost always going to assume stability, unless I have some other piece of information that tells me I should do something else. Now, once you know how much interest-bearing assets or debt you have, that is what's going to tell you how much your interest expenses for the year will be. So when we're looking at interest expenses, they will be based on the implied interest rates in the past. So if I go to, let's see if I go back to Excel. So here I see that in the past, for example, in 2011, I had interest expense or income in H&M's case of 563 million. And this was in relation to about 21 billion of financial assets. I can divide those numbers to figure out what is the implied interest rate for H&M. And that kind of tells me what that is in the past. So similarly, again, if I go up and I've calculated it, I can see that the interest rate has kind of gone a bit jumpy, but not very much. But 2.65 goes up to 3, 2, 1.87, goes up again, and so on. So again, this kind of tells me what it is. In this case, you could look at the last year's figure. The reason why I would say last year's figure is because the interest rate, this is not some company-specific information. This is basically the interest rate in the market. So if you can figure out what the bank's interest rates are for companies, you can know if this is a reasonable number or not. So whenever you see a number here, and if it doesn't seem reasonable, and when I say reasonable, it's really weird that it's either very different from previous years or it's very different from the rest of the industry. You need to make sure that it's somewhat reasonable in the sense that it's actually true and it's not just a one-off weird year. So if I see that this is 3%, I look and see that the market interest rate in that particular year was around 3%, that's fine with me. If I know that there's some projections in the market that interest rates are planned to go up over time, I might incorporate that. Otherwise, I'm just going to keep it stable because I have no idea. So again, you're basically just guessing with some form of more information if you have some idea. And again, when we're looking at this interest rate, this is exactly the same as when you're trying to calculate your weighted average cost of capital. You need to figure out what the cost of that should be. If you're paying a lower interest rate than your cost of debt in the WACC, it's something is weird because essentially the cost of debt in your WACC is how much you can borrow at. That is the rate that you're paying, and it should be very similar to this. So again, when you come to the WACC week, you kind of want to make sure that it's kind of getting the same numbers here. Tax expenses, again, to some extent, they tend to be stable. But again, as I mentioned, you need to make sure it's not something weird about this particular firm. In H&M's case, in 2017, I think that, let's see if I go back to the Excel spreadsheet. So in 2016, they paid 22.48% in tax. So again, tax rates and previous tax rates is basically based on how much you've spent on tax in relation to your earnings before tax. I see that they paid around, let's say, 24 down to 22% over time. What I would do is I would basically do a little sanity check. In a sense, I would compare it to the corporate tax rate in that particular country. So there's a link on that slide, and it basically takes you to the KPMG overview of corporate tax rates around the world. So in this case, I would go and down to Sweden, and I'd go and see what it's progressed over time. So I can see about probably 10, 15 years ago, it was 28. Over time, it's gone down to 22%. So again, the fact that they're paying 22.58%, pretty reasonable. There will be obviously deferred tax assets, deferred tax liabilities, so almost no company will pay exactly that amount. But if your company is consistently paying 5% and the official tax rate is 20%, you need to start to think about the fact, is this actually sustainable? So are we always going to pay a 5% even though the official rate is 20 or 30 or 40? Generally speaking, because when we are valuing a business, we're valuing it for eternity, we're valuing it as a going concern, we almost always try to make sure that this tax rate in our assumptions is based on something that is very close to the corporate tax rate, if not the corporate tax rate itself. So in this case, I might have just said 22% just to make it easy. So similarly, if you remember from your finance class, when you estimate the weighted average cost of capital, you need to throw in a tax number there as well. Should be the same as this one. So you basically need to make sure that things are consistent. So again, basically it's somewhat guessing, but it's somewhat like kind of logical guesses with some kind of rationale behind it. Another item that we need in a condensed statement is really working capital. And again, working capital is to some extent, if we want to make it simple, is your current assets minus your current liability. So it's your short-term capital that you have in the business to continue operating. So it's an indicator of how much capital you need to basically continue operating, but it's also an indicator of liquidity. So generally speaking, the working capital will be as a ratio to sales. So in order to generate a certain number of sales, you need to have a certain level of kind of short-term assets in place. So again, I would look at what is the historical pattern then. If the historical pattern is somewhat stable, I'm probably going to use an average or just the last year. So in this case, I can see that working capital to sales has gone up from 3.53%, and over time it's increased to 6.05. Again, I've selected 6.05 in my case because I said in the homework that I'm just going to assume the last year for simplicity's sake. In this case, if I wanted to do this correctly, I might actually start to think about why has it been jumping up and down a bit, and is this increase going to be consistent over time? Generally speaking, when companies talk about their future performance and talk about their past performance, they tend to talk about liquidity. So when you see them talking about liquidity and they want to increase liquidity, it generally means that this ratio will go up. Because in order for them to be more liquid, they will have more working capital in the business. So again, you could use the last year if you think that is going to be reasonable for the future, or you could try to figure out and adjust it based on company-specific information. We then have the last item, which is really capital expenditures. And again, capital expenditures is really your purchases of new equipment, upgrades, maintenance, anything that is basically capitalized by the firm and essentially made into an asset. Now, capital expenditures, again, very closely linked to sales, because in order to maintain sales growth over time, you need to reinvest in the business. And again, similar to the working capital and any other ratio, you look at the past trend. Is if it's somewhat stable, you could basically use the last year. Even if you have no other information, again, the last year almost always gives you the most reasonable prediction, because that's the most recent year. Obviously, you need to make sure that that particular year is not weird. But, for example, when we're looking at capital expenditure, if your company, for example, is kind of lumpy in a sense that it tends to purchase new equipment and very rarely. So one year they might have a huge capital expenditure, so that capital expenditure sales might be like 20%. Then it goes down to 0, then it goes down to 1, and so on. So it might be lumpy, which means that the last particular year might not give you the most relevant figure. So then you might look at the average. But if your past few years are somewhat stable, again, use the last year. Again, when you have information about a company, you can try to have a more accurate prediction. So again, if you were to do this internally within a firm, you know exactly what they're planning to buy. If you know what they're buying, you know what this ratio should be. So when we're kind of doing these projections for publicly listed firms as outsiders, we're kind of guessing using educated guesses. So again, based on all of these ratios, and if you've done the homework, basically we're using these ratios that we kind of estimated and forecasted to then forecast our future financial performance. So again, if we know what sales will be in 2017, and we know what the gross profit margin is, well, we then multiply our sales by gross profit margin to get this. We multiply sales by our EBITDA margin to get the EBITDA. If we know EBITDA and we know gross profit, we forecasted these two items. We can also figure out these two missing items, so cost of goods sold and SG&A. So again, if you know sales and you know your gross profit, then the cost of goods sold will be the difference, and so on. So effectively, you really only need a few line items and then their relationships with sales or some other item. So again, when you do the homework, you kind of go through this little exercise. What I should probably highlight is that whenever we do any kind of forecasting, we tend to think about it from a sensitivity analysis point of view as well. So later on, when we start to do our intrinsic valuation and our relative valuation, we almost always do them with an upside and a downside case. So we will have our projection based on what we think will happen, but companies might have a good run, they might have a bad run over time. So we tend to have a kind of an upside prediction and a downside prediction as well. in case, for example, H&M's productivity goes up, might open up more stores than they planned, or a downside case if they, for example, have a decrease in sales per store, if they have higher competition than we thought. So we essentially try to understand what is the projected range. So we do have our best guess, but then we might have an alternative case and kind of, again, a downside case and so on. And the idea here is that you get a range rather than a precise number, which again makes it somewhat more interesting when we start to value the business. Again, as I mentioned this week, we're primarily going to look at two functions in Bloomberg. So I already showed you EEB in the sense that you get a consensus overview. And I kind of showed you BRC, but I didn't, I guess, go there directly. But BRC is effectively the Bloomberg research portal for one particular security. So if I type in BRC, what happens is that I see all the releases that are kind of research related to this particular company. Whenever I see a release here, some of them we will have access to in the sense that if you see a document here, we tend to have access to that. So these things could be things like industry reports. So somebody might have analyzed the entire industry for Time Warner. They might be company specific. So here, for example, whenever I see a hold or a buy in the column, generally means that this is going to be some kind of a research report. So here I see hold. If I click on that, that's Needham. And again, it's going to open up a PDF and it's somebody's essentially recommendation to hold the security, so not buy or sell it. And again, this person then gives you their overview of why they believe that rating should be hold and what their price target is and so on. What you'll see is that most of these analyst reports pretty similar in structure. They'll have slightly different text and slightly different rationale at some points in time, but they'll be very similar to each other. So again, this is basically just an idea that you can get some information here about your company. So again, when you're trying to justify some of those figures in your forecast, you can try to source this. And again, as a sanity check or even as a first go in terms of, I guess, if you have no idea what you're doing, look at the EEB function to figure out what the consensus is amongst analysts. And again, you have to consider the fact that these people, they know a lot, but to some extent they are basing all of their predictions on what management is telling them. Because yes, they could change their predictions slightly from what management. So if management tells them we believe our sales will be 10 billion next year, they might adjust it slightly, but it's very rarely that these will be very vastly different. So it's not going to be 20 or 30% more. One, because management tends to provide quite accurate guidances, but two, all of these people, so here we have Brian, here we have Hamilton, their job is completely dependent upon how much Time Warner management likes them. The more the management likes them, the more information they provide them. The more they pick up the phone if they call, the more essentially they can give them in terms of valuable information. If they start to say that the assets of this firm is vastly overstated, that this is a horrible company, they're going to get less access to information. So we always have to remember these people are biased, but they still provide us with some reasonable information that we might use in our forecast. But again, everything that we see here is somewhat of guessing based on management guidance with their own little adjustments. Do I have any questions? Easy, sweet, straightforward, awesome. Again, we do have the midterm coming up next week. So on Thursday, I'll give a whole lot more information about the midterm. I'll also give you a formula sheet on Thursday, as well as the answers to all the questions we've had so far for the homeworks. Generally speaking, people have done quite well in terms of, I guess, writing for the homework, in the sense, even if you've written one sentence or two sentences, people are kind of in the right track. But I'll provide you with more detailed answers for the homework questions as well on Thursday. But again, as I mentioned last week already, if you want to do well in the exam, please do the readings. The readings are really, really long, and for probably next semester, it's not going to benefit you guys, but for next semester, I'm trying to summarize them to try to condense them a bit. But it is really, really useful in the sense that they're super useful readings that are very much on point. And again, remember, what I'm looking for is why. Not what, but why. So essentially, always think about what could be leading to this change. So it's not about the fact that current ratio shows liquidity, but why would a firm might for example, have high or low liquidity? What type of firms would have high or low liquidity and so on? So always think about why. Any questions?
Sorry, the exam is similar to homework.
It is similar to homework in addition to the homework questions. So I would also suggest is that you go through the readings because they will have examples throughout the reading. So when like really long and extensive examples, to be fair, where they give you an example of a company that's done fraudulent financial reporting, and it goes through how you would look at the numbers to try to figure that out. So for the midterm, what you'll be given is a Word document with questions. And for some questions, there will be an Excel document with financials. How you use those financials is completely up to you. I'll be giving you a formula sheet and so on, but I'm not going to tell you calculate the current ratio. That is up to you. So the guidance for the exam is really that you need to understand which ratios would be relevant in what particular instance, but you don't need to memorize how to calculate it. So it's really about understanding what it is, what it indicates, and so forth. Cool? Yes, so everything is done on the computer. So you're typing in the Word document. You're, again, doing your calculations in Excel, and then you're trying to use those calculations to justify whatever you say in the Word document. It's 1.5 hours long, plus I think a 10 minutes perusal. I think that's the official one. You've done these before. It starts exactly at 3:05 p.m. on Thursday in this room, so be here on time. And again, if you've never done a computer exam, I'm just going to scare you guys. So I haven't shown you guys yet so far, but hopefully nobody here cheats, but there might be an instance. Everything in this room, and it's a bit creepy here, I'll show you guys. Everything here that you do is monitored. So when I stand here during the exam, so this is just an overview. Let's see, Larissa's not doing anything weird. So I might go and view Larissa. In a sense, I might look at what she's doing. So I might look at view screen feed from Larissa. I can also say view all, and then I have an overview of like 20, 30 different people here. So it's a bit creepy. Not only that, but it logs like keystrokes and everything you've visited. So please don't cheat because it's really stupid. It's very, very easy to get caught here. So I shouldn't say I don't mind cheating, but basically it's a really stupid time to try and cheat during this class because everything is logged, everything is monitored. But again, the idea here is, again, try to just look at the slides, make sure you understand the slides. Once you understand the slides and the homework questions, go on to the readings. The readings is basically what's going to give you a better grade later on. Cool. Again, I'll see you on Thursday. If you want, you can start the Thursday work already, but if you want to go and have fun and relax because some of your group members might not be here, go and do that. Again, I'll see you on Thursday otherwise.